We're back today. Take a look at shares of Netflix, up better than 5%. Why? Because there was not one, but two bullish calls on that stock today. Maybe the most eye-opening one, overweight from equal weight at Wells Fargo. The price target gets bumped by $100 to $400. That's 28% from here. You see it's having a nice day, but still, what a difference a few months have made for this name. Also named the top 2023 idea at Cowen, reiterated outperform 405 the target. They were already at 340. So that's interesting too. It's leading the S&P 500. Shannon Saccocia, you sold Disney.
We did.
That plays into this story.
It does. It does.
Why did you sell Disney? And when? And at what price?
A couple of days ago, we sold Disney. So I think one of the challenges, so we've owned Disney for a long time, but we've owned it since it paid a dividend and was generating significant free cash flow. So sort of pre-Disney Plus. And with the content library that we weren't naive enough to think that they weren't going to have to spend on content. But I think the challenge is now is that there's really no near-term or mid-term road to profitability for Disney Plus, right? And with the execution up in the air from a management perspective at 22 times, I just look at the risk-reward trade-off here and think, you know what, I can be being paid in other things in my portfolio to wait for Disney to figure out how they execute. There's no doubt that the global brand has a ton of value and that can continue to be monetized and unleashed. But at this point in time, there's still too much overhang. We've got 2 years, and now it's going to be talking about succession for the next 24 months for a company that needs to execute right now. And so that's why we moved out of it. We added to Netflix earlier, a couple months ago, and we've held that for a long time. And I think that just from a streaming perspective, these two are likely to continue to be the big winners longer term. I just think the near term for Disney is just too uncertain. You also bought more of the mothership, Comcast. Just want to throw that out there. Obviously, our parent. Absolutely. Do you feel like the corner's been turned for Netflix now? Right, because I mean, let's not forget, it was a $700 stock. And we can make a lot about the fact of a stock moving from, the 200s to where it is now. And it's had a great move, and those who bought down low are obviously happy. But it was a $700 stock. Is it back on that journey? I think it's difficult to say. I mean, if your cost basis is such as mine is, and it's somewhere in the $200 range, mid 200s, you look at that rise, and hopefully you were taking some positioning off the table. But I think the other thing to think about is what is the. I think that what's happening now, Scott, is they're valuing the first mover advantage that Netflix clearly has, and I think they're also looking at it in terms of this is a profitable company now. They're looking at being able to deliver subscriber ads profitably and be able to land and expand their footprint internationally. So I think this is more an acknowledgement that there was a real advantage to being the first mover in this space, and that they're seeing all of these other streamers try to copy what Netflix is already doing, which gives them that additional value in the eyes of investors. Okay, let's throw out another call before we take a break. It's Costco, which is obviously on the back of its earnings, named top 2023 pick at Cowen, reiterated outperform 650, which is surprising, Rob, when I read your notes today. You say it's, quote, under review. Why is Costco for you under review? Listen, the tailwinds associated with this company are certainly still very strong in terms of customer loyalty, the environment getting tougher, but it's just based on price, Scott. It's gotten too expensive. And so when we're thinking about what we want to own going into a more difficult environment, and the performance that you've seen from the consumer kind of staples areas, this stock has just been too expensive. Too expensive. All right, so you sound like a guy who's selling it. What is this under review nonsense? We have a committee. We run 2 portors. We have a dividend income. I mean, you sound like your dog died. Like you're about to break down. You know my vote on that committee right now. Okay. Well, no, that's what I'm trying. That's what I'm trying to get at. That's what I'm trying to get at. Let's not beat around the bush, right? Let's not beat around the bush. People listen to what you guys have to say. You're voting to sell the stock in terms of the conversation you have on your committee. Yeah, but let me tell you this. When you think about how you're positioning, it's about what relative value you find out there. There's tax consequences of selling. We've owned this name a long time. And so positioning when you're managing money for taxable investors has to be very thoughtful. We're in December. It's December 9th today. When do you want to sell it?
right? What could change? What positions could you bring into the portfolio? So you can't make a decision in isolation. We are not traders. We are money managers. And when you're a money manager, you're positioning relative to what else you could be in and how long you've owned it and what gains you have. So, you can't make these decisions in isolation, which is why you have to be thoughtful around it.
Okay, no, I appreciate that. I feel like we got a little more clarity there. Thank you for that.